Hey, welcome again. It's good to see you. Unfortunately, we have not had the live last week. Jay has had knee surgery. He's feeling better now. And let me ask Jay. Let me start by asking you, what has caused you more pain, your knees or the markets?
Exactly, Roberto. Good to be with you again, and sorry for the delay. But yes, a week ago today, I had knee replacement surgery on my left knee. I played American football in college, but that really wasn't the issue. I also did a lot of mountain climbing back in the day in Nepal and Tibet, in Mongolia. And I think it's all that pounding, when you're up 18,000, 20,000 feet and you're taking my body weight, a pretty big guy, my body weight going down all those mountains, all those years, basically
Oh
destroyed
yeah.
my left knee. So it was time to get it done. And that was really the thought in Friday's musings, right? Was the pain in my knee, which is, pretty significant, or was certainly last Thursday, Friday, is not as significant as the pain that one feels, certainly at TBW Advisory, with our model portfolios, obviously having, experienced some absolute down performance. But it's more portfolio pain than knee pain, which I guess is a good thing for now. And hopefully the knee is getting better, and I do feel better, and I'm up walking around. So thank you for your concern. And hopefully in the portfolio front, we'll have some relief as well as we go through the next couple of weeks and months.
Fantastic. So, and as you said, pain is, can be good sometimes. So, are we? I mean, and you're very good at, looking through the fog and the noise. So, are we starting to see, the end of this, and can we start to talk about inflation? Then we talk about the other factors that have driven down the market.
I think we're getting to the point where we've discounted an awful lot. And I thought I saw something in Twitter this morning titled "Bear Food," and it went through a list of like five or six things. Goldman Sachs cutting U.S. GDP estimates, cutting the S&P year-end target, the EU cutting Europe's growth estimates and raising the inflation estimate. China retail sales in April obviously being pretty horrific. And then we had some grand titans like Ben Bernanke and former Goldman Sachs chair Blankfein talking about very, very high risk of recession and very high likelihood of stagflation, et cetera. And that was all, what the market had to absorb on the open today
Yeah.
after, a very strong Friday, which was a lot of people looking at Friday. I'm not a technician, as you know, but I pay attention to the technicals, particularly in markets like these. And a lot of the technical folks back clearly marked Friday as an important day. It was a 9% up volume day, which typically is found around basings and bottoms. So I think the market action today was pretty decent, given all that bear food that we had to discount. I think the Chinese ETFs, for example, held in quite well, given how bad the data was, and I think that says that data has been absorbed. Right? We've put it into our minds. It's discounted. It's in the price, and that's where we have to get to. We have to get to a point where things are in the price, and then we can start moving accordingly. And I wrote again in the musings, the price is the price, right? The price on the screen is in fact the price. Whether it's the right price, we won't know for a period of time, right? Because it's discounting a future that's as yet unknowable. But I do think we've made a lot of headway in terms of sentiment. We've made a lot of headway in terms of positioning. We've derated equities, right? A number of the big banks were out talking about how equities have been derated by 30 or 35% over the last, 4 or 5 months. You've had the pullback of 18%. You've had earnings growth over that period being decently robust, and the combination of the two means that we've had a pretty significant derating. And now you're at a point where the S&P, for example, is trading under the the 10-year average on a forward PE basis. And you have a situation where a number of markets, like in Europe and emerging markets, are in Japan, are all trading between 10 and 12 times earnings. So one has to suggest, or one would, I think, have to think that we've come a pretty fair way in discounting whatever's coming down the pike. And I noticed that JP Morgan on their work over the weekend said that the way they analyze it, US and European equities are discounting 70% probability of a recession. So that's, I think, an important data point, right, to think about. A major firm, a high-quality macro firm with Marco and his team there, saying that their sense is that in their analysis, not just their sense, they go through a whole process to get to that percentage. But their view is that the markets are discounting 70% probability of a recession. And it's interesting because they contrast that with the credit markets and the sovereign markets, which are discounting the less likelihood of a recession. And I think that's pretty important because, credit is always the dog that barks first, right? Because credit is where people feel that withdrawal of liquidity and that difficulty in accessing financing way before the equity people do. So credit typically leads when you're going into a recession. And this, one of the things that's kept us relatively constructive through all this the last couple months is the fact that the credit dog, has not barked, right? Credit has held up very, very well, particularly high yield. The investment grade's been hit worse because it's got more duration, and duration is really what's been hammered, right? The longer end of the yield curve. So credit not barking, and sovereign spreads and sovereign rates now looking like they're rolling over, right? We had 3.2% on the 10-year. Now we're at 2.8%. You've had inflation expectations come in significantly over the last couple of months. You've had break-evens come in over the last couple of months. So I think, the bond market sniffed this out first and reacted very aggressively, right? Tightening on the front end has been, not seen since the 80s in terms of the speed of the tightening on the front end. And that's what's really smacked the high growth names in the equity space. And that was where, when you think back, because all of us, I'm sure, are kicking ourselves and saying, jeepers, how do we get to this place where our portfolios are down for the most part? I would imagine most people, if they're invested, are down. And one of the things that I got wrong during this period was the rate of speed of that discounting process. And it irritates me because I've been all about speed, right? We've talked about COVID speed, climate speed, conflict speed, and yet the speed at which the short end of the curve tightened so aggressively, which led to the sharp sell-off in the high growth names, which in turn led to a whole nother leg down for the thematic names. That's the part that really has hurt our model portfolios, both our global multi-asset and our TPW 20 thematic model, because our view was that rates were going to rise, right? And that was going to cap the ups to the US market in particular, given the tech weighting. And that would set the stage for non-US equity to outperform. And instead, what happened was that they didn't just roll over the fangs, right? They've crashed. They're down 30%, 35%. And the thematic names, which had already been in their bear market since last February, they've taken a whole nother leg down. And I think, again, that's really where it's kind of interesting, and we can get into the portfolio implications of that later. But that's, looking back and kind of thinking like, where did I go wrong? Where did we go wrong at TPW advisory? That's one of the areas where we got it right directionally, right? We knew that big cap tech was going to underperform. We had virtually no weighting in it. We knew non-US was going to outperform. That's where we're very overweight non-US equity. But the discounting cycle was so short and abrupt and fast, it just set off a much greater, faster correction or arguably bear market in the FANG type names, which, as I said, then led to the thematic names taking a whole nother leg down.
Mm-hmm. No, this is great, and there's a very good comment. You mentioned about the Fed avoiding inflation. So and then I remember in sessions a few weeks back, you mentioned also that the Fed does not need to break anything. So, is you think they're going to achieve that? Given the last statements and and the pressure that the market is, parts of the market are putting on it to give 75 basis points. I mean, how do you see that trade off and that move going forward?
Yeah, the way we've tried to lay it out, Roberto, is kind of doing a little bit of scenario analysis, right? And talking about two camps. One is the inflationistas, right? The people who think inflation is going to be out of control. Deutsche Bank is probably the lead big name on that view. And then a whole nother camp that thinks growth is very, very slow and the Fed may tighten into a already rapidly slowing economy. Those are the two kind of parameters, I think, that are out there. And I think we're moving on the market front away from the inflation is just going to get out of control to more concern about the growth. And I say that because of where rates have gone, right? We touched on it a few minutes ago. 10-year U.S. Treasury peaked at 3.2% 2 or 3 weeks ago. It's now at 2.8%, give or take. Commodities, which were spiking, Brent at 135, now is at 110. Copper, which was at 5, is now at 4. So I think a lot of the pressure there has kind of been taken off on that front. And then we talked about how break evens and other things are rolling over. So I think we're now kind of segueing into a greater challenge or greater focus on the growth situation, right? And certainly the calls for stagflation and recession. I just noted that Blankfein of Goldman Sachs and Ben Bernanke both out over the weekend talking about recession / stagflation. So that's kind of the topic du jour. The topic 2 weeks ago was inflation. I think we've now kind of, we've beaten that thing pretty much to a pulp. And now it's time to turn to the other side. And I think when we think about recession, it seems to be still not really visible, at least to me. I mean, I look at things like traditional leading indicators like jobless claims, for example. Jobless claims look perfectly fine. There's absolutely nothing that suggests we're anywhere near a recessionary environment, because certainly jobless claims would start to pile up if you were getting close to a recession. You also have, a very, very strong household balance sheet, right? Net worth, notwithstanding the big sell-off in equities, net worth in the U.S. and in Europe has been off the charts the last couple of years. So households are fine. Corporates are fine, right? There are trillions of dollars of cash on corporate balance sheets in the U.S. and Europe. And so there's no default risk. And that's why high yield has hung in reasonably well. Spreads have widened, but again, there's no indication of the action that you see in high yield when a recession is imminent. So I look at jobless claims, I look at the strength of the consumer, I look at the strength of the corporate balance sheets, I look at the strength of the financial sector, right? Banks are all, cashed up. They have great, ratios. We've all repaired ourselves very well since the great financial crisis. So I struggle to see what's going to kind of really drive a recession. And then I look at earnings and I look at companies, right? And analysts. And we just got through Q1 earnings and beats were better than expected. We're now 90% through the U.S. Earnings season, 70% through Europe, and 50% or so through Japan. And across the board, both sales and earnings have been better than expected. And J.P. Morgan, again, you need to look at the big firms who have the analysts to kind of gross up the data on things like earnings and revisions. And JP Morgan's earnings revision indicator for both the US and Europe has turned back up, stating that more positive revisions than negative revisions in Europe and the US. And that just doesn't foot with an imminent recession. Okay, if you can tell me, oh, there's going to be a recession by, in the next 24 months. Okay, it's very possible. But in the next 6 to 12 months, when, companies and analysts are talking and, they're making, they're changing their estimates, et cetera, et cetera. And I know, the canard about there's always buy ratings. That's not what I'm talking about. I'm talking about earnings forecasts where analysts do, try to get to a decent number. You were an analyst. You understand what I'm talking about.
Yeah.
So I don't, it's interesting. I don't, you're certainly not getting any sense from earnings. And what's happening is basically quite simple. Companies are able to pass through the input price cost increases that they're getting. They're able to pass through into the broader economy, partly because people, have money, like we talked about. Companies are in good shape. And so there's an acceptance of price increases. Now, one could then turn around and say, okay, well, that's inflationary. And one would be right. But one can't say that there's going to be a recession and inflation. I guess that's where stagflation comes in. But I don't really like the stagflation term because it's very soft and squishy. And, some people say 2% growth is stagflation, when the 5-year pre-COVID average for the U.S. was 2.3% growth. So that's not accurate. We certainly aren't talking about big stagflation for the last 5 years. So I don't really like the stagflationary term, but I'm just trying to point out that when you drill down to some traditional leading indicators of recession, like jobless claims, when you look at corporate balance sheets, household balance sheets, you don't want to see those risk areas, those areas of deterioration, right? Bad debts going up, defaults in high yield, et cetera. That's just not visible, not happening. And so I struggle with the idea of recession in the near term over the next 6 to 12 months. I continue to think it's highly unlikely in the US and in Europe, because Europe earnings are still coming through fine. Again, it's like the Ukraine and Russia and the conflict there is horrible, but the rest of Europe is reopening post-COVID. Travel is soaring. Hotels are fully booked. Again, you can tell us probably more so from your own experiences in Europe.
That's true, yeah.
Yeah, so there's no, not hunkered down. We spent the last 2 years hunkered down under COVID. And so part of the challenge now is we're switching from kind of goods demand generated inflation, right? Everybody wanted goods because we were locked in our houses. And then we had the supply chain snarls. And so good pricing got out of whack. That's now going away as we open up post-COVID, with the exception of China. Now it's service demand inflation that's starting to come into fore, right? And so that's one of the reasons why I thought last week the market really didn't like the inflation number, even though it was slightly lower than the month before. Did argue, you could make an argument that the peak is in, but it was opaque and it wasn't really, significant enough, and it was worse than consensus. And that was kind of like a hangover, like you're all ready to party and have a good time. And then bad news comes and the party's canceled and everybody just walks away. Oh, horrible. So that's kind of how I saw the market action last week, particularly Wednesday, Thursday. And now I think, as I say, we're morphing from a focus on inflation to a focus on recession. And where we come out at TPW Advisory is we think there's a middle path, right? We are proponents of a middle path, a path that says inflation is going to continue to come down, probably towards something like 4% at the end of the year. Growth is going to be fine, 2.5% to 3% in the US, same in Europe. And that's where people are settling in. EU came out with 2.7 for Europe in 2022. The consensus Bloomberg for US is right around 3% for 2022. Goldman, when they cut their number, I think they cut it to 2.7 for 2022. And again, I want to remind everyone that the pre-COVID trend was 2.3% growth in the US on per annum 2015 to 2019. In Europe, it was less than 2% growth from 2015 to 2019. So when people say Europe is going to grow at 2.7% in 2022, understand that that's significantly faster than what the pre-COVID trend was. Yeah. And therefore, earnings are probably going to be okay because people are now, we get back to that high nominal growth environment that you and I have spoken about many times. Yeah. If you have 3% growth and 4% inflation, that's 7% nominal growth. And let's remember that earnings and sales are determined in nominal dollars. So 7% nominal growth would be about double the nominal growth in the pre-COVID period. So when you look at earnings expectations at single-digit earnings growth, and you think about a nominal growth rate environment of 7%, you can kind of feel like, okay, those earnings should be doable, right? And now we've brought down the multiple such that you're not paying a lot for those earnings, right? You're paying 16 times in the US now forward, 12 times forward in Europe, 12 times in Japan, 10 and a half times in emerging markets. So we've done a fair bit of work across the board. So our view is that we're going to be able to kind of thread the needle. We're going to get the middle path. The Fed, Powell coming out and saying 50 basis points in June, 50 basis points in July, I think is fine. The market is desperate for some clarity, right? Desperate for some clarity. And giving clarity like that is fine. And I think once we get through July, the Fed's going to want to pause a little bit and see what things look like. See how the economy is responding. See how housing is responding, right? I mean, the mortgage rate's gone up. It's nearly doubled over the last year. So housing, which is a big driver of, activity and jobs, et cetera, is clearly going to be slowing. You look at the tech sector. I spent a fair bit of time over the weekend on some podcasts, VC and PE, private equity type podcasts, and the message has gone out, right? As I mentioned in the musings, right? I already have heard that Wall Street banks have put on a hiring freeze. That's already out there as of last week, right? Big name, not going to mention the name of the firm, but the top 5 bank hiring freeze. And you're already hearing in Silicon Valley and in the tech space, extend your runway, shrink your cost structure, live to fight another day. That's the language that's now, in a heartbeat, right? Because, 6 months ago, people were raising money left, right, and center, and more than willing to pay, higher and higher multiples. And so now we have a situation, again, in the thematic space in particular, where the public market multiples are much lower than where the last private, multiple was done or valuation round was done. So I think the private sector, if stock prices stay anywhere near where they are, there's going to be some real blood in the PE and VC space when they have to mark their holdings to market. And I think we've seen some of that in the action last week, even in the hedge fund space, right? There's a lot of talk about Tiger Global being down 70%, these crossover hedge funds that were playing both in the public and in the private space. And their books must just be an absolute mess because they've taken the hit on the public side and they know that they're going to have to take the hit on the private side. And so I think I think there's going to be a lot of choppiness in the more in the private space, perhaps in the public space. The public space has led the correction. The private side of thematic and fast growth is what needs to catch up now.
Yeah, and there was an interesting, comment that I saw today, from BlackRock, and they said that 90% of the move in rates has already happened. So that goes pretty much in line with what you said. So a lot of the tightening has already done. And he doesn't see a much bigger movement in rates than what has already happened, and that may be even the short-term rates. So, uh, I mean, having anything else? I mean, any other comments? And would you add anything to that?
No, I agree with that, and I think it's historically accurate. If you look back, the peak of rates in the last several cycles, each peak has been lower than the peak before, right?
Yeah,
So the market, part of that's because we've taken on a lot more debt as societies, right? Part of that is we just run at a kind of slower growth pace and less volatile growth pace, right? So when we talked about the 5-year pre-COVID growth of 2.3% in the U.S., okay, well then obviously rates aren't going to be that high. You're not talking about 4 to 5% growth. So it's very clear if you go back and look, the peak in Fed funds over the last 3 or 4 cycles, each one has been lower than the one before. And so I think we're probably, this is what I mean by the super aggressive nature of the tightening on the front end. The
yeah,
2-year note was at 50 basis points in November of 2021. And by March of 2022, 4 months later, it was at 2.7%,
yeah,
220 basis points of tightening, that's now in the market. And this is where, as I wrote in the Musings, the Fed job owning and the market, the fixed income market, taking that job owning on board and acting on it, then led to the whole thing with the public market equity space, as we discussed. So I am sympathetic to that view. And the way we've kind of thought about it is you take that 8% inflation number and you break it out into 2 parts. One part is kind of flexible inflation, right? And let's say that's about 5%.
hmm,
That's due to the COVID and supply chains and China and Russia, Ukraine, and energy prices, okay? That's volatile. That's going to come down in and of itself over time. That leaves you with the 3% kind of sticky inflation. And that's the inflation that the Fed is really focused on because it doesn't want to get it embedded into the
yeah,
whole wage side of things. Which, by the way, if the economy does kind of slow in some sectors, that becomes less of an issue as demand for labor becomes less, and therefore pressure to pay up for labor becomes less, and the wage price spiral becomes less as well. So the Fed focuses on that 3%, and that's really what it's targeting. And so you're already at, a Fed funds rate, terminal rate is around 3. It fluctuates, but it's around 3.25. The 2-year is at 270, 250, 260. So it's gone quite a long way to that point. The 10-year is at 3%. So we're getting in the ballpark, and so I think that would be kind of coincident with the way the BlackRock folks are thinking as you laid out, and is similar to we laid that out 2 weeks ago when we talked about the destination and the path. Right? It's not the destination; it's a journey.
yeah. No, very good. And there's another thing, which is an important, part of your, middle path scenario, which is the capex boom. Is that still the case? I mean, have you changed your view or not?
No, I have not changed my view, and it's great that you brought it up because, one of the things I wrote in my musings on Friday, because it was Friday the 13th,
Yeah,
and I couldn't resist using that in my title, given how crazy and spooky the week and the prior couple of weeks have been. So I posit in the musings, could this all be for the good? We've had a scary ride, we've had a spooky ride. It's not all diamond hands and YOLO mentality, right? Like we had a year ago at this time, right? It's a serious business. Investing takes discipline and it takes the ability to, be wrong sometimes and to move forward. But I think that the important thing about the Fed not pushing the economy into recession is that it opens the door for that higher than expected high nominal growth rate environment in 2023, 2024, 2025. If we do go into a recession, then that makes that out year outlook more difficult to to achieve.
Mm-hmm.
If we're able to navigate through the current environment where 2022 growth comes in at 2.5%, and we end up with Fed funds somewhere around whatever 2 to 2.5%, and inflation's at 4, and it's on its way down, then I think we can have that environment of inflation between 2 and 3%, growth between 2 and 3%, and we have a nominal growth rate environment in the U.S. of about 6%, again, compared to 4% pre-COVID. And you have that capex boom, which is clearly needed with COVID and climate and conflict, right? Our 3 Cs. We see it happening. The papers are filled with stories about nearshoring and reshoring and friendshoring, mm-hmm. all the tripolar world regional integration that we've been talking about for years is now, you can find it on the front page of your paper almost on a daily basis. And so that's a big driver. The focus on climate, that's a big driver. The focus on just traditional infrastructure, certainly in the US, right? Certainly in Europe, in Japan, in Asia, all that, those are all kind of in place. And so you have an environment where that demand, where companies again are still cash rich, where rates will be higher, but they're not high by any historical nature, right? So could still borrow and find projects where a 3% yield, 3% rate on their paper, they can find projects that they can make money on, finance that rate. And you have the productivity surge, which is the other part of it, right? Capping the inflationary pressures. And I do think that if we ever get through this period of just endless COVID, climate, conflict, if we ever get into some sort of path where the 3 Cs are not banging on our heads every minute of every day, then I think we can see that there is going to be some significant productivity enhancements from all of this, and that is going to support that better than expected growth path over the next several years without surging inflation. So to me, the Fed's ability to navigate here without breaking things, and then that's why I make the point. There's nothing that says the Fed has to do that. Nothing. It's just the way things have been done at times in the past. Nothing says it has to be done this time. And I don't see Powell as a guy who's uber hawkish. I don't see the Fed as, filled with people who think inflation's lurking behind every closet door. I think it's a Fed that's going to try and navigate the path. And so they've gave us clarity now. We know what's going to happen in the next 2 months. That's great for the bond market. That's great for investors. And then we'll see where we're at, and we'll navigate forward. But I believe by July, we're going to see inflation in the U.S. at 5 or 6%, down from 8.5%, and working towards 4 towards the end of the year, where earnings growth is going to come in, better than expected, supporting stock prices. And there are going to be opportunities to take advantage of the sell-off that we've seen that have now led to significant deratings across the investable universe.
Mm-hmm. No, fantastic. Can we move now to China? It's it's been a rough year, and I mean, is now the time when we see the worst behind it, and they're going to start releasing like rolling back some of the lockdown measures in Shanghai especially. Can that relieve some pressure off the supply chains and markets, of course?
I think so. I mean, I think so. I think you laid it out really clearly there. I wrote in the Musings that GavCale, which is a well-respected firm
Yeah,
known for its expertise in China and Asia, they made the point that lockdowns in the 100, not just Shanghai, everyone's focused on Shanghai, but China is filled with big important cities, right? And
yeah,
GavCale has a list of the top 100, and they pointed out that in three-quarters of them, restrictions are either gone completely or back to levels that existed pre-Omicron. So I think China is, they've taken a big hit here. It's interesting that they've been so willing to suffer near term to maintain kind of the dynamic clearing zero COVID approach that they've had in place for a couple of years. And it's fascinating because you have, as we've discussed before, you have Putin, who has isolated himself and is fixated on the Ukraine, and arguably you have Xi in China, who may not be as isolated as Putin, but is he's pretty hard to reach, I would imagine,
yeah,
but for most people, and he's clearly focused on zero COVID, right? And so neither of these leaders seem ready to turn. I've had the view that time is not Putin's friend, and I think I continue to stick with that, both on the battlefield and economically. I point out that you can talk about China retail sales being down a lot, but automobile sales in Russia fell 78%
yeah. I
in
saw.
April, 78% year on year. So don't fool yourself. The Russian economy is imploding in real time, and its military force is not having success on the battlefield. So, and in the case of China, obviously much more important for investors because I think the energy weapon that Russia may wield in Europe has already been diffused to a large extent. And we could get into that if you wish. But sticking to China, we had the China Glide Path 2022 thesis that things were going to be smooth, that they had the policy flexibility, both monetary and fiscal, to keep things smooth in front of the likely third term for Xi in the fall in the People's Party Congress. And obviously, it's been anything but a glide path. So we've been quite, we were quite wrong. I mean, the Russian invasion hadn't occurred when we laid out that thesis, but COVID and Omicron certainly had. So, we did not cover ourselves with glory with that particular perspective. And we have trimmed our China equity position over the last couple of weeks in respect of the fact that that's not been the right call. But we still have healthy positions, both equity and fixed income, both local currency and US dollar, because I do think that the bottom is, we're finding a bottom in China as well. And, they are jawboning as the Fed is jawboning, they're jawboning the idea that they're going to support the economy. I've been disappointed, as I think many investors have, in the lack of concrete policy action to demonstrate that support. And I have to think some of that's going to come fairly soon. But I'm also heartened to think that these lockdowns will ease fairly soon, and the supply snarls and pressures on the commodity front will also, ease shortly. I mean, I do think we have to recognize that if China was going full bore, then the pullback in oil and copper and other commodities that we've seen in the last month or two would most likely not have happened, and we would be having a bigger question mark on the inflation side, right? So it's again, we're confronted with so many balls that it's hard to see like a clear road forward. But in the case of China, valuations extremely cheap, particularly on the tech side. That's where we kept our tech position in China, and we kept our A share position as well. So we have a view that COVID lockdown is ebbing, and it should be, hopefully, for the most part, less of an issue going forward. and there will be more concrete policy action in the next couple of months, so that China has the capacity to continue to grow its economy at something close to 5%, right? I mean, everyone knows that China GDP forecasts are numbers that are set for a reason, rather than the amalgamation of data as is done in the U.S. and in Europe and elsewhere. But clearly, we'll see more. I mean, the earnings for Chinese tech companies, I believe, are this week and next week. So we'll get a feel for some of this. And I really like how the markets responded today to the China data dump, right? Data was very disappointing. And again, the US listed A shares and KWeb and other things were flat to slightly up. And I think that's a really good sign that says, investors have fully discounted that April is going to be a write-off for China economic activity. I think we need to, if it extends through May and into June, then that's going to be a bigger problem again. But my guess would have to be that that would be met with much more aggressive policy action. It's actually been quite interesting that China has not pulled the policy lever, either on the monetary side or the fiscal side, and they have room to do both, right? As we know, I mean, they have plenty of room to cut rates if they so desire. There's no inflationary pressure in China. Inflation's at 1 or 2%. So they have plenty of room on the monetary side, and they have plenty of room on the fiscal side. And yet they're really, they're really keeping their powder dry. And I also think, people are starting to make the case that the bottom is in on the property side. Did look like they lowered the cost, right, for first-time home buyers to try and, generate some demand on the property side. And again, the market, you had a big bankruptcy of a major Chinese developer last week, and the property space barely blinked. I think this has been going on since the summer, right? Evergrande, remember Evergrande? I think it was in August, right, where it was going to be like the thing that destroyed the world, and it's still puttering along.
People are comparing to Lehman,
yeah, and it's still puttering along. And so now 6 months later, another Chinese developer goes bust and can't meet its dollar obligations. The thing that's interesting is that the issuance of Asia high yield has collapsed. I was reading today it's down 90% year over year for high yield dollar Asia issuance. So that Asia high yield investors who are getting repaid and getting dividends, right, are piling up cash. So I think there's quite a we have a position in Asian high yield, and it's holding in reasonably well. Thankfully, it has a pretty good dividend yield, which offsets some of the price erosion since we purchased it. But our thought is that with the issuance down so significantly, that means there's a lot of cash to support the existing positions. And should things stabilize and turn up, then you could see a real nice lift in some of that in both the tech side and also the property side.
Yeah, no, this is great, and I want to go back just to a theme you mentioned, a few minutes ago. Was the energy in a weapon, in Europe, and how and the reason why do you think Europe is being successful in getting rid of its dependence on Russian oil?
Yeah, no, it's in part just a matter of time. Right, they've now it's been February to March, April, May, 3 months, give or take, and they've been able to identify alternative sources, right? So U.S. LNG is going to Europe, tankers are being rerouted, and all this type of thing, and that's why I say China's kind of slowing, probably at the margin certainly doesn't hurt the pricing environment. Well, helps the pricing environment in that it reduces demand, which is what we're talking about. And so you've seen that in the European natural gas price, the benchmark price is down 60% or so from its peak when it spiked after the invasion. It's still up considerably from a year ago, but it's nothing like what it was when people were really freaked out. And similarly, oil, right? Brent peaked at 135, and today it's at 110. Now, arguably, it could start to work its way back higher if China does reopen, right? Then you're going to start to see more demand. But you also at the same time are now 3-4 months in, and ideally you'll see more production from the United States, from OPEC plus, et cetera, to kind of offset the shortfall that is coming out of Russia. Because I do think it's pretty clear that Europe is determined to really wean themselves off and really limit Russia's ability to sustain its conflict via the energy channel, right? And so it's not only sanctioning, or it's not only embargoing or not taking Russian oil or gas, it's also sanctioning any tanker or insurance company. And that's the thing that really bites, right? And that's what the U.S. has used to really isolate Iran in the past, for example, is secondary sanctions. So you may not be doing anything directly with the entity that is being sanctioned, but if you are indirectly, you can still be subject to sanctions. And that's where Europe is going with its energy plan to include sanctions like that, which will make it very, very difficult for any shipping company, any insurance company that wants to deal with Europe to do anything with Russia. And so, it's a little bit of a battle here where Russia is saying we're going to stop shipping to you, and Europe's saying we're going to stop buying from you, and it's this back and forth. But the price action, has been relatively quiet, and that suggests that there's been enough time so that things have started to fall into place. It's no longer the winter, right? There's a lull in energy demand relative to peak, January, February, keeping houses warm, et cetera, et cetera. And so I think there's a lot of that which has stabilized the situation. And, absent a full cutoff one way or the other, I think we're probably Europe's going to limp through, at least on the energy front, limp through, 2022. And the real question is going to be, next winter, right? November, December, January. How is what's the gas inventory look like, right? But that's going to be a question for another day. We're in New York right now. I can tell you I'm a little hot because a very muggy day here at the start of summer, and getting ready to turn on the air conditioning, but getting close. So we'll deal with Russia and European heating for the winter in a couple of months.
No, that's great. And now, we can move on to the themes. Despite the bad market action, it looks like we were talking before. Your themes have worked pretty well, and at least most of them. Like the bond short and the value versus growth. Can you comment on that? And how do we see things going forward?
Yeah, that's one of the frustrating things, right? Is that a lot of our themes have played out, right? We've been very negative, big cap growth, and that's worked out really well. Been the worst performing segment. We've been arguing for non-U.S. outperformance versus the U.S. That's happening through this period, year to date. We've talked about small caps doing better than big caps. That's still the case. We talked about a bear market in bonds. Clearly, that has been the issue. We've become a little bit more constructive, given what we've talked about with inflation, et cetera. But bonds clearly have been on to one of their worst starts in all of history. and then the commodity bull market, and as you mentioned, value over growth. So all those things have worked, as I said before. But in this market, in this environment, if you're doing global multi-asset, which is our flagship model, is the global multi-asset GMA, TPW20 thematic model. If you're doing global multi-asset in an environment like this, something is going to be wrong somewhere, right?
Yeah.
And the only thing you can do is try to like hopefully limit that, and you're not too far off sides. And as I talked about earlier, we already went through the whole issue of the big cap tech sell-off being more aggressive and faster than I thought, leading to the thematic space getting hit and taking another leg down. And that's where we got hurt, because we have virtually no big cap tech in our model, but we do have thematics in our global multi-asset. And then obviously in the thematic portfolio, it's 100% thematic. And in a, kind of a very difficult environment for, let's call it high beta, that portfolio has struggled on an absolute basis, right? For sure. Basis to peer group and to some of the indices that are much more kind of innovation. There's an MSCI innovation index that we use to compare the performance of the TPW22. The performance has actually been pretty good, but absolute performance, it's down and down significantly year to date, which is frustrating because there's been absolutely no place to hide. And so, we talk about things like ARC, for example. 3 or 4 months ago, I thought ARC was interesting. We never added it to the portfolio, but we look at it as kind of a peer in that thematic space. And I thought around $65-$70 it was interesting. And lo and behold, it got down to $35. It got cut in half again. It had already been cut in half because it peaked at 150 back in February of 2021, not 2022, February 2021. ARC peaked at $150. And so I thought, okay, I'm looking at it, it's down 50%, and valuation is kind of reasonable, right? You can get the valuation on a price to sales basis for the ARC portfolio. And it peaked at over 30 times sales, as an illustration, okay, in February, March of 2021. By February of 2022, the ARC portfolio was selling at about 7 or 8 times, with sales growth of around 40%. And that was versus NASDAQ selling at about 6 times sales with about 20% sales growth, right? So you're getting double the sales growth in ARC versus NASDAQ for, a 20%, 30% increase in price to sales valuation. So I thought that was kind of reasonable. And what, of course, has happened, as I just said, ARC is halved again. But now, as we talked about at the beginning, you have this situation where the public companies, valued on this price to sales basis have come in dramatically. And they are now well below kind of historical levels in terms of valuation. And similarly, to what we talked about earlier, the private market in that space needs to adjust considerably. And that's what's going to be interesting to watch. I think there is going to be potential for M&A, right? For people to come into the public market and take out some of these high quality companies that are trading at significant discounts to the private market. We've seen a little bit of that. People sniffing around Peloton, for example, people buying some of the cyber security names. So I think that part of the environment is quite interesting, but it's been a situation, as I said, an environment where, particularly if you have a constructive view, as we have, one of the challenges, and I wrote about it in the Musings, is, how do you maintain a kind of constructive medium-term view, let's say a 1 to 2 year term view, in the midst of very aggressive, fast-moving, downward-facing price action in the markets, right? Because what typically happens, people do one of two things, right? They either freeze, do nothing, just freeze, they're frozen, or they capitulate, sell everything, and go to cash. And I've learned enough in my 30 plus years that neither one of those is the right approach most of the time. And so we have been trying to navigate through this with that constructive medium-term view, because as we've spent the last 45, 50 minutes talking, you can make a case, and a reasonable case, I think, for that middle path, for that
Yeah.
reasonable view.
No,
And
I
so
agree.
that's been hard. But, that's one of the things that I think when people look at TPW advisory, they look at Jay Pulaski and they want to see somebody who's been involved in the markets and who understands how to navigate through difficult periods like this and is not going to freeze or is not going to capitulate. And when you have global multi-asset, you should be able to navigate and do reasonably well. And I think we will, notwithstanding, the year-to-date start, which has been very difficult for stocks and bonds. But I think over the course of the year, we're going to end up it's going to be an okay year. Probably not going to be a great year, but I think it's going to be certainly an okay year and not a horrible year. The difference will be if the Fed, makes a mistake and drives us into recession. Then the markets, even with the JP Morgan's argument that, markets have priced in 70% probability, you'll see those earnings come down and you'll see, multiples probably have to
It
contract
compounds,
a little bit further.
Yeah.
No,
No,
as
and we
we
have
talk, we've got a big thunderstorm and rainstorm outside here.
oh, I can imagine. At least it goes down a bit.
Yeah, it's maybe.
I don't know how you're
maybe
getting home, but
I'm home. I've been working from home with my niece, so I'm actually home.
oh, that's fantastic.
But
So you don't
yeah,
have to worry about it.
yeah, no, I don't have to worry about it. But it's one of those things where it's super muggy and just all of a sudden opened up and started to pour. So hopefully it will cool off a little bit.
Yeah, we got 2 minutes left, and there's something that I forgot to ask. I mean, are you worried at all about crypto? Because it seems that this sell-off, let's say comparing to let's say 2008, where the focus was the housing market. Now it seems to be crypto. So I mean, some stuff going to zero, a lot of
Yeah.
suicides. And are you worried about leverage and some contagion from that market?
Not really. No, I mean, if we're going to have an implosion, let it be in crypto as opposed to housing for sure, right? Crypto is a $2 trillion now, $1 trillion market. It's very small in the absolute sense. I do think that crypto, the story is being called into question. I definitely feel that way. I feel that way personally. It's not lived up to its billing as a hedge. It's traded, Bitcoin trades just like tech, tick for tick, no diversification benefit whatsoever, no inflation benefit whatsoever, no real proof of use. There's nothing that says this could be something that's used widely. So I think it's going to be, crypto is going to be a show me story, I believe, going forward. I, for one, admit to being disillusioned. But broadly and more importantly, let me just update you and your audience quickly on some of the model changes we made last week. One, which was to add to our Brazilian equity position. We initiated a position there a couple of months ago, caught that nice run up, and then we had pulled back and gave back almost the entire run up. That to us is a nice opportunity to step back in, and that's how we're trying to navigate these markets, right? Not pay up when things run, but when they sell off, if we still have conviction, to step in. So we did that. We reduced our China equity position, as I mentioned. Part of that went to add to Brazil. Part of it went to establish a position in Southeast Asia, where we think the equity opportunity is quite interesting there as well. And then the other thing we did was we kind of took on a little bit more risk in our fixed income position, and we added a U.S. high yield position with the spread now being about 500 basis points over. We think we're being compensated. And as I said, credit has been the dog that didn't bark, and all this concern about the economy and recession. So we are initiated with a small position there to kind of take on a little bit more risk, because I do think that the bond market, for the near term at least, has seen its highs. And now we're going to focus, as I said, less on inflation, more on growth and recession risk. And therefore, probably bonds continue to kind of maybe rally back towards 2.5% or something like that, which would give the high yield position a pretty nice kicker while we get to take advantage of that high yield.
All right, this is it's been great, right on the mark, and again, great summary. It looks like we're seeing light at the end of the tunnel, and
Let's just hope it's not the. Let's hope it's not the train.
Yeah, that's right. And get well soon. Hope hope you're being able to walk and do your stuff soon. And take care. We'll see you in 2 weeks.
Excellent, Roberto. Yeah, thank you for that. I'm on the mend. I appreciate your concern, and many people have reached out, and I really appreciated that. It's really sweet. I didn't mean to put that in the musings as an attempt to wish Jay well, but more because I thought it was pretty funny because I was in pain from the surgery, and then I looked at the portfolio and I was like, oh my God, it's even worse than my knee pain. So I just thought it was kind of a funny little analogy to use. But I appreciate your concern. And it's always great to be with you and be with the Ohm family. So thank you. And yes, indeed, we'll see you in a couple weeks.
Thank you. See you. Cheers. Bye-bye.
Bye-bye.